live Thursday event. We've got Michael Voulgarakis with us in the waiting room. I'm really excited to bring him on. He's got a ton of experience in the commercial and then capital raising space. So without further ado, let me bring him on to the show. Hey, Michael, thanks so much for joining us.
Thanks for having me. I appreciate it.
Absolutely. Why don't you just start by giving the audience a little bit of background? I know you've been doing this for a long time, and just kind of bring them into how you got started in real estate and up to current day, if you don't mind.
Okay. Well, I've been working in commercial real estate for about 18 years now. I started out as an appraiser, underwriter. Then I was an asset manager, and more recently become a sponsor. I have a master's degree in commercial real estate finance as well, and along with my partner who founded our company, Southgate Real Estate Ventures, we focus on acquiring multifamily value-add assets in the Puget Sound region of Washington State. That's it from a high level.
Yeah. When did you decide to get your master's? Were you already involved in real estate, or was that something that you did early on?
I did that. I had a prior career in. I was working for some tech companies, and my family was involved in single family building, and I worked on houses when I was younger. And then when I was working for some of these tech companies, just sort of as the itch sort of got to me, and I employed a strategy where I was reaching out directly to owners of condominiums that hadn't been sold for 20, 30 years in a particular part of the town that I lived in. And it turned out to be pretty lucrative. I was able to buy, renovate, and flip a bunch of these units. And I understood some of the basics of income producing real estate, an apartment building, office, etc. But I was afraid to utilize the capital I have and try to buy an asset, because it's an illiquid asset. If you buy it, you're going to own it for a while. It takes a significant amount of money to transact in and out of it. So I said, I'm going to go back and get a master's degree. And then I got my first job in commercial real estate in conjunction with that.
Okay. What did your first job look like?
The first was appraising properties in primarily New York City, but really the Eastern Seaboard. Multifamily. We also did a lot of conversions from industrial buildings, let's say in Brooklyn on the waterfront, to either office or mixed use retail and multi, or office and retail. Ground up condo developments, raw land purchases for development, future development. So it really ran the gamut of experience. And then I got a job thereafter on a CMBS desk, underwriting commercial mortgage-backed securities, which was, I moved to the debt side, started learning how institutions underwrite properties with long-term debt. And then the Great Recession happened at that point. So things got a little hairy for a while, but I found another position when those CMBS desks shut down after the Lehman collapse, and kept going.
Yeah, that's incredible.
So, Michael, what's your focus now?
It's value add multifamily in the Puget Sound region. My partner has been running the company for 8 years now, and I've been involved full time for 2. But prior to that, I was working a full time job and contributing what I could to that venture while working a full time job. And full disclosure, I don't live on the West Coast. I'm on the East Coast. So my partner moves out there. I invest money with him, and this is a former colleague of mine, by the way, that I worked with. And what could I do from 3,000 miles away on the other side of the country? Well, I can source deals and I can raise equity.
Mhm.
So we did ground up sort of bootstrap stuff, that the stuff that I did when I was finding deals, flipping condos. Got a hold of the right databases, scrubbed the data. I said, I think this is the play. Started sending out direct mailers to thousands and thousands of owners. Get a temporary cell phone, wait for it to ring, and start and scream deals like your life depends on it. And surprisingly, it that has helped us. I think it helps other it helps other smaller, growing firms, because it helped us get recognition, if I can call it that, from local brokers, right? Yeah, you buy a duplex, a quad, they don't really care about you. But if you buy a 7-unit off market for an incredible basis, they're like, okay, who are these people? And then you do it again. Now they want to talk to you. And I think that's one of the critical things that, um, any sponsor has to do, is develop those broker relationships. And that helped us get a foot in the door.
So tell us
Very
about
cool.
the Puget Sound market, because like I don't know if Mark, you're familiar with it, but I'm not familiar with it. I've only been out there to vacation, and I
Right.
certainly wasn't looking at multifamily properties. So
Well, it 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 the primary investment thesis is this, and it hasn't changed in 8 years. It is following high tech, high paying job growth, whether it's in Amazon or some ancillary company, Microsoft. There's an incredible biotech presence there as well. And when my partner was the one that picked the market. Like, we were going back and forth, and he's like, no, this is Seattle. I've been there. This is the one.
Mhm.
And he pointed something out to me that really stuck, which was, here is the average in-place rent for a 1-bedroom, 2-bedroom, etc. in Puget Sound 8 years ago. Here's the average rent for San Diego, LA, Portland, and San Francisco and Silicon Valley. And there's a huge delta there. So he said, even if the rents don't get as high as those markets, there's plenty of room to run there. And we think, you buy there's plenty of rental growth there, so to speak. And then you overlay that with the demand for job openings, the in-migration. We're going back to the basics here of real estate investing. And then you look at the average pay for those jobs, and in some of the zip codes we're investing in, the average household income's north of $140,000, which
Mhm.
is double the average, give or take, of the national average.
Mhm.
So, these are well-to-do folks, good paying jobs. They need housing. Third, we looked at the supply. And the city was built primarily, post World War II. There's a lot of 60s and 70s vintage properties throughout the city and the surrounding areas. And they're very, very small format, right? So what they did is they interspersed single family properties with small multis. So you have 2 single families, then an 8-unit, then another single family, then a 12, then a quad, on and on and on.
Mhm.
Now, there's too much demand for that zoning to stick. And the city and the state, I will actually credit them for recognizing that, we don't want to be a NIMBY type of market. We need to promote the production of new housing. So in one of the times that they upzoned the land is in 2019. So instead of being able to build a single family house only on that property, you're now able to put a quad, or you're able to put an 8-unit or a 10-unit. It varied by location.
Mhm.
But they're trying to encourage, through zoning, the increased production of housing, which I think is the right thing to do. And the second thing is, it's interesting when you go there, you can be standing on a hillside staring at Amazon's headquarters. It's a 3-minute drive away, and you're standing on a single family home. It's very, very rare to find that type of dynamic in the city. And it's just, to us, we say long term, this is not going to be the case anymore. They're going to have to go up. They're not going to say, no, it's single family zoning only and exacerbate a housing supply. So what the city has done and the state have done, well, let me start with the city first. They did the 2019 upzoning, which is very helpful. So it increased your floor area ratio. In 2024, there is another upzoning that is scheduled, and they're going to expand the commercial zones where you can build multifamily housing. It's going to bleed into the single family zones because the majority of the city is still single family zoning. And so that's fantastic. And then at the state level, which I wasn't terribly familiar with this being on the East Coast, but I think California and maybe Oregon has done this as well, or might it be Idaho. But the governor of Washington, and really the Senate, just passed a House bill statewide that allows or really mandates that someone is allowed to build more than one unit in a city with more than 25,000 people if it's single family zoned. Some folks are up in arms about that. Like, it's my locale. The local municipalities are not too happy about it. But it's just another way of showing how the problem, I think, is being taken seriously, and they're doing what they can at the state level to encourage more accessory dwelling units, knocking down a single family and putting up a quad or 2 townhomes, whatever. The more of this, all around is just needed.
So, Mark, I have two questions for Michael. First one is, have you or would you be in the business of assembling parcels and developing?
Great question. So the answer is yes. And we have not, full disclosure, we have not developed anything on our own. But over the past few years, a number of our properties we have realized are what is called covered land plays. Are you folks familiar with what that is?
No, educate us.
Okay, so a covered land play is simply any interim use of a property that covers the current expenses until it gets developed. So it's not a cash outlay. You're not bleeding cash while you own it. So you could hold it theoretically for a lot longer, right? And you're saving your dry powder, your liquidity, for better use versus just paying the taxes and insurance on a vacant piece of land. So we have a number. This is all until you can develop the plans and scrape and build. So we have a couple of lots that fit that bill, where the cost of the land, or really the value of the land, is either at or approaching the value of the land plus the improvements on it because it's been upzoned. And we sort of, my partner and I are like, we have to become developers at some point, or backing up a step. No, why don't we can contribute these properties to a joint venture with a developer and say, we have the land, you have the expertise, we know enough about it where we can ride along, but we might decide to participate that way depending on the parcel. And as far as assemblages go, the longer you're in a market, we're starting to realize that the better off, because brokers are starting to say, hey, the building you have that we sold you that has, that's a 9 unit. Now you can build 50 units. Well, the owner next to you who has that little 6 unit can give you another, 20,000 square feet of raw land. Now you can build, however many more units. So those sort of the benefits of being in a market and for long term, start to really show themselves in that way. We're hoping to take advantage of that in the future.
Yeah.
Okay. My follow-up question was, and Mark, I'll stop monopolizing here, but
No,
this
you're
is
good.
all fascinating to me. So New York State, pretty sure you're familiar, is Governor Hochul, wanted to have a, goal of producing 800,000 housing units in New York State over the next 10 years. And one of the ideas included sort of superseding local zoning, right?
Mm-hmm.
A lot of people that were for that were against, this sort of NIMBYism that happens in terms of stonewalling new multifamily development, um, were concerned that when the rubber hit the road, that there would be a challenge to the constitutionality of those types of things. So how has Washington dealt with that? Because I mean, we're all governed by the same constitution, really, across the states. So has there been challenges to the constitutionality in terms of those things?
Frankly, I don't know. The reason why I don't think enough time has passed, this bill that was passed in Washington State just happened last month. So it's really, really fresh.
Mm-hmm.
And I haven't seen anything addressing your question directly, except for, the write-up in, for example, the Seattle Times, where local municipalities are just railing against it. But
Mm-hmm.
one thing that I'm not sure whether New York had proposed similar terms for their legislature, but in Washington State, you don't have to build multiple units. It is up to the landowner,
Mm-hmm.
right? So, they're just giving you the option. And if you want to monetize your parcel and you have a single family and you're going to build 4 townhomes, you're able to do that. But are the municipalities going to your point, contest it? I don't know yet. I think it's too early to tell. I'm sure there will be some resistance from a municipality or two or multiple. Maybe they form a coalition, but we just haven't seen that yet.
Okay, cool.
So is your main goal to then go for these covered land plays and just stack as many as possible, knowing that you're going to be in a really good position, owning all these key pieces
Yeah,
of real estate?
yeah, that would be fantastic. But they're sort of needles in haystacks, right? It's only in certain parts of land, but it's the first thing we do when we have a deal come across the desk is I go to that what's called the comprehensive plan for 2035 comprehensive plan.
Mm-hmm.
And I look to see whether that property is currently in an area that's been upzoned and if it's slated to be in an area that's upzoned. So at least I know, okay, this is what we're dealing with. Size it as a regular multifamily value add initially, because if it doesn't work initially, we're not going to do it. We're not the Vornados of the world or these large institutions where we can afford to carry a property and just outlay capital until we figure out how to develop it. We're just not there at this point. So yes, we'd love to find more of those, but I think the bread and butter is going to be just value add multi, and we're actually not adverse to looking at a condo conversion play or a stabilized deal. Given some of the properties that we've seen so far, properties that are newly built that the developer is just trying to get rid of it because they have other projects that they're trying to salvage. So sure, I'll step in, take the leasing risk, lease up a brand new building, put a property manager in place and clip a coupon. I have no problem with that either. So we're a little bit of opportunists, but we want to stay focused. I think I want to stress we want to stay focused in the Puget Sound region and not get distracted by another market at this point.
Are sellers using this upzoning as like a marketing ploy to get people to come in and overpay for properties, or is that still kind of under the radar?
Our typical seller is, again, these are 60s, 70s, 80s vintage properties. Our typical seller is an individual or couple that bought 1 or 2 buildings because they were like Boeing engineers or Microsoft employees, back in 1990 or 1985 or something like that, and they've had it for all that time.
Mhm.
They are not keeping up with the current laws as much as they probably should. So they're not looking at it as, hey, this is a developable land. They're saying, hey, we've got a building here you can with rents in place. So I think there comes a point in time in people's lives, and it's natural, where you're trying to take it easy and you don't want to be glued to your computer, reading every single law that they're passing. And they've made their money, right? If you bought a building for $500,000 in 1985 and now it's worth 7 million, I think you've done okay. I think they say, yeah, it's time to go to Hawaii. It's time to retire and go hiking. And that's what we typically see.
So, Michael, you had mentioned the word focus. Do you have a sort of a value add business plan in a box? And if so, what does that look like?
I wouldn't say it's in a box, but there are a couple main categories where you can add value to a property. One of which I don't think it's kind of rare, I think, to find maybe in a garden style apartment. And that's a little bit of conjecture on my part, but one thing I think people overlook is, can you add, if you want to really increase value, does the building have the ability to add an additional unit to it, or units, plural, or increase the bedroom count for some of the units, right? If you can take a bunch of studios and turn them into one beds into twos to threes, depending, by taking some underutilized space, the return is just massive. Adding a unit is obviously the best way to go, but that is certainly more expensive. You're replumbing an entire and wiring an entire unit and framing it up. But if you have a 40 unit building and you add 2 units to that, that's an incredible increase in your top line revenue. So that's one thing we always look for. Of course, you do it legally. You have to go through permitting, which takes time and energy and money. But it really does add a massive bang for your buck. The next thing I would say is your typical value add strategy, where we're trying to determine what improvements to make to a unit in order to get the maximum value. Another thing is RUBS, or utility reimbursements. So many of the properties that we're purchasing do not have that in place. And on the expense side, things just continue to get more expensive. I mean, the city of Seattle is charging us more for common area electric, water, etc. And we're legally allowed to implement RUBS, or ratio utility billing systems, utility reimbursements, and incorporate that into new leases as they roll, and basically neutralize that expense line item, which is a huge boost to your NOI. Pet fees, as well as storage fees, they're typically, everyone puts in that there's, in a 40 unit building, there's going to be 30 pets in there. I would say there's 5 or 6. I mean, I would never really rely on that to make numbers at all. And then on the expense side, if you're buying an asset, and I think this might become more common in the future, but you always want to look at what your purchase price is compared to the assessed value that the municipality has, pegged the property at. Because if you are anywhere below that assessed value, you have to hire a tax certiorari, which is also called a tax appeal attorney, to go argue for you to get your taxes lowered. So that's one of your other biggest expenses you can drop down if that's the case. It's one of the cases why you should always try to get the lowest purchase price too, right? $100,000 below AV can make a difference in your taxes. The more the merrier, that type of situation. Insurance is a tough expense lately. It just keeps rising. I've spoken to our insurance broker and a number of people who are in the insurance business, not necessarily for commercial real estate, but in other realms. And I say, well, what's going on here? Like, how are they spiking by double digits? They just said losses, natural disasters. So these insurers are just increasing their rates. The only way I can think of, and we've implemented this, to lower that is if you can get to a particular scale, whatever that might be, you go to your insurance broker and you say, I need a blanket policy for all these properties to see if I can shave some money off of it. Now, to be frank, we didn't save that much by going to that route. But every dollar helps at this point on the expense side.
How do you get that extra bedroom? Are you like gutting the unit, moving walls, or are you repurposing like a dining room, from like a vintage, like, hey, we need to have this formal dining room and turning that into a bedroom? Or is it really, no, I've got to go in and open up this 700 square feet and figure out a way to get an extra bedroom into it?
It could be all of that. The other thing that it often is, and this mostly, at least in the vintage buildings we're dealing with, it happens on the first floor, where there is a common area hallway with an oversized laundry room. And if we plan on getting rid of the laundry room, we're going to recapture that space. It has to have the proper, forget the term, but light and air, right? It needs windows. It needs to be up to code. And if we can do that, we'll take that space. The other place that we take space from, and I alluded to this a little bit before, is storage units. There not as many people rent them as I've found. Even, we thought, Pacific Northwest, everyone skis and hikes. They're going to have a lot of stuff to fill these lockers up with, dog crates. It doesn't really happen that much. So, I can take that, those 4 or 5 storage units, make an extra bedroom out of them, and that's an extra $400 a month, or whatever it might be. So those are some of the ways that we capture. Also, if there is an unusually large unit, now that's more typical with older vintages, right? So if you have an average, one bed of 900 square feet, that can be a 2-bedroom unit, and it will be accepted by the market as a 2-bed if it's laid out properly. You don't want to have some sort of strange abomination, of walls and stuff like that. But it has to be tasteful. But that is one of the things we do. We also, for top floor units, we've put skylights in before, which it's sort of, my partner's like, oh, these, the renters, their hair is blown back. Like they walk in, they're like, yeah, I want to have it. I get some sunlight in my living room or something like that. So those are some of the ways that we will recapture unused space and create extra rooms or units.
Mm-hmm. Do you put laundry in the units, or do you not even bother? And then what do you do for like common space? Do you give any kind of amenities, or is that going to be like on a case by case?
So for laundry, I now I'm realizing I should have mentioned laundry when I was talking about the revenue side, because I forgot a very critical piece, which is the market today, especially in that market with those professionals, they want in-unit laundry. And if we can do it and it's cost effective, we're absolutely going to do that. It has to do with where is the existing plumbing stack. You can run wires to it, but if you don't have a plumbing and drainage stack, in a closet or something like that, it starts to get difficult. But we do that in every single unit that we can. Absolutely.
Mm-hmm. Yeah, I've found that in our market, because our market's definitely changed a lot. I mean, Mark and I have been in this business for a while, and when we first started in a multifamily, we're in some like younger hip areas, some places that all of us would have lived at after college, and just to have on-site laundry was an amenity with shared coin-op laundry, right? And things started to change over the years, where there was people coming in, they're like, I'd show them the apartment. This is when I was doing, managing the operations myself, and like they're looking around and like, where's the laundry? I was like, it's in the basement. I can show you that next. Oh, you don't have in-unit laundry? And so that was a major aha moment for me. I was like, okay, the demands of the consumer are changing. And so we added in-unit laundry, and we're able to get like, $150 to $200 a unit more per month, just by having that amenity. So it's definitely a game changer for us. So it's definitely a testament of like, being, having your finger on the pulse in terms of what consumers are looking for.
Right. Absolutely. I couldn't agree with you more. I mean, I lived in New York City for years where, your laundry was in the basement or around the corner. So, and people just, it's not accepted in many markets these days.
Mm-hmm.
Yeah, I don't know if you want to take a step back maybe and talk about the marketing piece. I love marketing, and that's kind of how we source all of our deals ultimately. So if you want to spend a little bit of time just on how you've got yourself set up, are you still the one doing it? Do you got a team that's helping you with the marketing? What do you think's the best bang for your buck? Do you just do direct mails? Do you do cold calling, warm calling, and what does that look like for you?
Well, we haven't. Honestly, I'm at the beginning of my journey of broadly marketing what we do to investors. We have had a core group of investors for pretty much the 8 years that have been with us and reinvested. We've done 26 deals in that market. Some people have been in 20 plus deals. So, but we're at the point where we've outgrown, those sources of capital, and that's why I'm part of the group with Hunter and you, Mark, and trying to understand the new landscape of raising capital from investors. So I'm starting with a drip email campaign, putting content out there. I'm hoping that the experience that my partner and I have, he's got about the same experience. So combined 34, 36 years of institutional experience. We're hoping we can provide value to your listeners here, as well as other folks, if they start receiving content from me, and they can learn from us. Beyond that, I haven't gotten much further than that at this point, since I'm so new.
What about on the deal sourcing side? Because I know that was one of your superpowers that you talked about earlier. In our marketplace, if you can't find a deal, you're just not doing a deal, because the numbers on the MLS just really don't make sense. So you got to get out there and be able to shake the trees and find some fruit falling out.
Right. Yeah. So we have been screening deals, but I would say that to anyone who wants to, whether you want to be passive or you want to be active, you always have to be screening deals to keep your pulse on the market. Always. If you stop for a while and then jump back in, I think you've lost sort of that like mental muscle memory, where you're like, oh, this is bad, maybe good. You can easily categorize deals the more you look at it. It's just an experience thing. But we have essentially, we haven't bid on anything yet, because there still is, we think, more price discovery to occur in the market, right? The bid-ask spread still doesn't make sense on most stuff. However, list prices are just list price. So, you have to be taking shots on goal. You have to be bidding on stuff. And it's a bit of a waiting game right now. That's it. We're at a point in the cycle, which is like, every other cycle, where there's price discovery is going to happen. You don't know how long, you don't know when. You just stay in it until you find something that says this is going to work. The other piece of the coin is, we're probably getting too large to source deals, that is, from a direct mail campaign. In our experience, it typically works better on an owner with a smaller property, whatever that might be, 20 units and under, 30 and under. But if you start getting above that, oftentimes you're starting to get into like middle market size transactions. It's more sophisticated borrower, might be corporate. If it's corporate, it might not work. It might, but 30 units and under, let's call it. I think you're going to find more success there, and we're trying to find deals that are larger than that ultimately.
Yeah.
So we might not employ that strategy again. We might, if we might employ direct outreach if we have covered land play parcels and we recognize that there is a contiguous lot next to our lot that we'd like to have to increase the floor area ratio. We might do that. So how do you source deals? I would say for anyone that is getting started, I said a minute ago, you should be sizing deals all the time. Well, how do you do that? You have to get to know brokers. And my partner was very smart, and I recall him saying this way back when. He said, "I'm going to get to know all the young brokers, the people that are starting, the people that don't. They need to get a deal done, and they're going to come to me with something." Now, the other side of that contract is you have to close. And I think we've closed on every deal that we've said we were going to close, and I think that is a paramount importance, because once you do that, now you can grow with that young broker, and they will start feeding you deals that fit your criteria, and that's a real I think the long-term relationship building is very important. And don't think you're just going to go on Crexy or LoopNet and buy that first deal. You need to screen a lot of deals before you buy one to really know what you're getting into.
Yeah, I'm 100% in agreement with that. I mean, because the brokers that have a established book of business, those guys are out, those guys and women are out, playing golf right now.
Yeah.
Waiting for bid ask to converge and that sort of thing. But I found in terms of our partnership with the younger brokers, not just like young in age, but ones that are starting out, is that, this guy's still working part-time at a brewery, slinging beers just to, get tip money to keep the lights on at home.
Right.
And so those professionals are going to, you give them a prospect list, like I would own any one of these 100 properties.
Yep.
And here's why. Go out and make contact with the owners.
Right.
And so I think that is definitely a great strategy to lean on, because right now, I mean, I think deal flow is one of the more challenging things in our industry right now. Capital raising has gotten a little bit harder from the standpoint of, that's the tail wagging the dog. I had
Yes.
deals I was raising capital for 3 years ago where I was offering out my investors, a 7% fixed rate of return on deals, and I was oversubscribed on all of them.
Mm-hmm.
Now, fast forward, we have, those same investors can put their money into an FDIC insured money market account and earn over 5%. So that combined with bank rates being higher, is just going to be factored into, how much lower you have to make a purchase on to actually, fit your return requirements.
Right. Correct. No, I completely agree with you on that. And, that going back to that price discovery, that bid ask spread, the premium that you're offering is not enough over what they call the safe rate, right? Buying something that's FDIC insured, or a treasury, if you will. Although there's troubles in that arena too, with the downgrading of America's credit ratings, but that's another podcast.
So let me ask you this on the capital raising on the capital raising side of things. You said that you've had the same well of a handful of investors. You mentioned drip campaigns and that sort of thing. How are you sort of expanding that net? Are you using stuff like lead magnets, for instance, in terms of hey, here's something of value for free, and if you want it, you got to give me your email address, so to speak, to really kind of increase the size of that net, or what are you doing on that front right now? Or are you still trying to figure out what these strategies on that?
That is exactly one of the strategies that I'm rolling out. I'm in the midst of it, still building out the infrastructure, and trying to. I think the most important thing is to determine what sort of questions or knowledge does my target investor want to know about. I can go writing about and creating content about all this real estate jargon, and sort of bore people to death with it. But you have to bring it back to, okay, what are their goals? What are their financial goals? What are they trying to achieve? And what questions can I answer about whether it's my partner and I, the deals experience, the actual deals themselves, as they come through. To me, I view it as it's a conversation. That's how we've had 25 loyal investors over all these years funding. But to go forward, I do need to produce more content to them so I can get to that point where I'm having conversations with people, so that it can be more in depth, if you will.
Yeah. So here's where I think the all of our target investors, I think that the ones that we really haven't really tapped into yet are the target investors that are under the misconception that you have to directly own real estate, dealing with the tenants, trash, and toilets and all that stuff, and time, most importantly. That's the fourth most important T, in order to get exposure to real estate and all the benefits thereof.
Right.
So presents like a really big challenge in terms of customer education, which is a huge undertaking when you think about it, right? Like I had a have you heard of what a crumpet is, Michael?
No.
Let's say no. Okay. So I have a tenant in one of my buildings that opened up a crumpet shop. I've been to, actually there's a crumpet shop, I believe, in whatever that market is, where Pike Place Market in Seattle or something like that. That my tenant was inspired by that and opened up a crumpet shop in Rochester, New York, in one of my buildings. I have a mixed use apartment building. And I was like, oh, this is great. I know it. I've had crumpets before and that sort of thing. And they open up. They've been wildly successful since then. But that customer education in terms of like what the hell a crumpet is, right, is kind of the same type of effort that we have to make in educating that target investor that may not even know that they can get exposure to real estate and get way better returns, more tax efficient than your typical vehicles through REITs and stocks, bonds, and mutual funds. Do you agree?
Yeah, I do, and I think some of our core investors knew about the tax benefits, especially. Our investors are accredited, right? And a lot of them are living in, because we used to work in New York, so there are contacts from New York. They're paying an incredible amount of tax on their W-2 income, right? And I've heard things, post tax season, where they're like, my accountant tells me I need to invest in some more deals in order to, because I'm maxed out on deductions with my kids, with business, with everything. They're half joking, half being truthful. Like, just keep me in the loop if you find something that's worthwhile, because I don't think enough people know about that, Matt. And I do think people need to understand, from a high level, when did this change? What was the law? And what the landscape looks like now at this point. You're right. If they don't understand that there is an opportunity, how can they ever move forward with that opportunity?
Are they able to take those losses against their normal W-2, or is it all compartmentalized just based on those assets? You can only take depreciation against the cash flow coming in.
My understanding is that it goes against their W-2, right? The losses on the K-1, which is the tax form that each LP or limited partner gets, if there's a loss on it because of depreciation, et cetera, then they're able to deduct that against their W-2 income.
Yeah, Mark, they're capped at a certain amount though. So I think it's about at least in New York State, or at least in my particular situation before I became a classified as a real estate professional, was $25,000 per year. So if you're a high income earner, then yeah, that can translate into some significant savings. But there's actually one of my students, his wife, he's a high income earner. His wife is did Pilates instruction and that sort of thing. So, and just really was sick of it and that sort of thing. I was like, all right, well, why don't you make her real estate professional, involve her in the business? That way, if you're filing jointly, then you can take your losses and not have to carry them as much forward with the net loss carry forwards, and wash out a significant portion of your W-2 income. So that's another strategy as well, in terms of couples that file jointly to gain tax efficiency.
Yeah, I know a lot of doctors that do that. They have their spouse get licensed.
Mm-hmm. So a follow up on the because I'm kind of fascinated and intrigued by this customer education type of thing. For the content, I've definitely found that I need to, I started off very technical in terms of talking about COCs and IRRs and waterfalls and all of this stuff, right? And then and cap rates, and I found that my content got a lot more effective at least provoking conversations with people that were at least intrigued on it, was when I, kind of brought it down to retail level, right? Because then that prompts a potential conversation. And a lot of times, 99% of the time, the people you talk to that have an interest in investing in real estate, can be, kind of like one or two scenarios, right? Is that they're going to do a deal themselves, right? Or they're going to want to learn about how to invest passively, which I don't know about you, Michael, but I'm really jealous of our investors. I mean, I want to be there one day, because I was like, they don't have to find the deal. They don't have to sign, they don't have to sign on the dotted line when it comes to the, to the loan, and dealing with all the brain damage associated with getting this thing up and running and stabilized and all that stuff. So I think that it presents a really attractive thing. And, I'm curious to see, especially with your group, and how those sort of marketing strategies can, kind of revolutionize the way that our country thinks about that. Because there's a lot of accredited investors out there that don't have any direct exposure to real estate and or passively invested in it. So how do you kind of engage, culturally with those with that segment of the population?
That's one of the things I'm trying to figure out. But I had a call with someone recently, and I was spinning a little bit, right, in my own head, thinking about just that very thing. And they said, well, give me a list of, or just rattle off the professions of your current investors. And I did, and there's a really clear trend there. And he said, that's who, you understand their education level. Most of them are in financial services firms, but some are in real estate, some are in, on equity desks, some are fixed income salespeople or analysts, real estate attorneys. And so they have a baseline knowledge of finance, but they might not be familiar with, it's just too baseline, right? They don't have the time to go buy their own deals. They're not going to do that. They're not going to give up a job that pays, a healthy amount. They want to invest passively, but it's just a totally different world for them. They just don't know. So I'm trying to figure out how to, what content to put out there that, as I said before, I don't want to, nerd out on super techie real estate jargon, like you were saying, IRRs and all this stuff. Try to break it down so that it's not as, it shouldn't cause stress, ultimately, or it shouldn't cause anxiety. They should get comfortable with, and things can get more complex as time goes on, but especially in the beginning, I think it's important if you're teaching anybody about anything, if you jump to the 400 course, you're going to lose them. Let's start at the beginning, and to your point, start with how you're able to invest in these deals. What laws changed, what our thesis is, and let them ask questions from there, if you will.
Yeah. What kind of returns are you seeing in your marketplace?
Well, for a value add deal, you are seeing stuff that would be in like the mid to high teens for an IRR. Cash flow is going to be a little tougher in a market like Seattle. You're probably going to get more cash flow southeast, but with that, there's a different type of risk there. We sort of go back to the financial strength of the renter, and we can sleep comfortably, with that. If the economy really does, fall and become much more difficult than it is now, whether it's a recession or, a bump, are we going to fare better than a building that cash flows more but has a less stable employment base? That's the thing that I think people have to weigh when they're making an investment, because you are in what's called the first loss position as an equity holder, and we like the downside protection, I'll call it, of that strong renter. And in the case of a covered land play, it's as a friend of mine would say, it's a belt and suspenders for the downside protection. I mean, there's very little downside to the deal at that point. So that's our mentality, and that's what I'd rather focus on. Now, that might not be for everybody. Some people might say, no, I need at least an 8% cash on cash or something like that, and that's fine. Everyone has different goals. That's part of getting to know different investors, educating them. If my message resonates with them, then I think more of the investors that fit and agree with our thesis are going to come to the forefront. We're going to get to know them.
Yeah. I have the same battle when I'm working in my market. A lot of people chase the cash flow, and that's definitely not my model. So
yeah,
right there with you.
Yeah, I mean, you have to have coverage, obviously, debt service, and but I would warn people that don't just look at the IRR and the cash on cash. You have to take a step back from a deal and look at the market, the macro market, the micro market, the street, the building, what it is now, what it's going to become, the sponsor, what their experience is, and go from there. I would start on the demand side of things. How much demand is there for this unit? How much supply is there? Is there a crunch? Are they building enough units? And if you have that sort of, I don't want to say metrics, but if you have that sort of scenario, that's what produces, healthy, steady returns in any asset class. If you can marry those two things together.
Yeah, for sure. That's great advice.
Yeah, Mark, I think I have the same frustrations with that. I mean, myself, I'm motivated by long-term equity multiples on deals, and there is this thing. I think it may even be a safety type of thing that, okay, I'm getting some type of distribution yield on my original investment that is telling me that this thing is performing better than something else, right? But I mean, I just looked at a deal that was in Boston. It was a 10-unit deal in a great neighborhood. It was an off-market deal for $2 million. Okay, so 10 units, $2 million, and this particular area has a historical rent growth of about 7% per year over the past 20 years. I was like, well, you probably got to raise 50% of the total capital stack in equity, but at the end of 5 years, if you have rent growth that sustains that, and you have a really high barrier to entry in that neighborhood, you're going to turn that into $100,000 in net operating income on a 4 cap, which seems really, really low, but you got $2.5 million in equity at $100,000 a year, and that's just added to the net operating income. So yeah, I mean, that's like, and there's a lot of people that gravitate towards our market in Western New York because, I mean, Rochester it's still a Rust Belt town. I think we have a lot of long-term stability and upside, but we have a lot of investors that come to our market looking purely for high cash flow.
Mm-hmm.
And the investments I underwrote that, I made a lot of mistakes in my day, right? And I think Mark, has got some battle scars to prove too, that, those properties those deals that had a high cash flow, usually turned into being our most mediocre deals.
Oh, really? That's how it turned out? Sorry, guys, I'm going to turn this, the sensor in this room went off. Sorry.
Oh, no worries.
Yeah, I think this goes back to, different people have different objectives, right? My partner and I look at, we have a medium to long-term outlook on the market we're in, right? Boston, I would say it's very similar, right? You have an incredible academic environment out there, turning out incredibly bright, talented people that are going into high-paying jobs, right? If you're touching that in any way, shape, or form, do you think that's going away anytime soon? I don't think so. And I would bet on that. Now, if you need the cash flow, or if you're just that type of investor today, I understand it. But to your point, if you were to acquire something now, which is, arguably we are on the downslope side of the cycle, right? And if you can be conservative in your leverage and renovate it and work the property during this period of uncertainty, where are you going to be when things stabilize again? I think you're going to be in a very, very good position. Some people are panicked though right now. They don't have the stomach for it. But a combination of proper basis and low leverage, and can you capture any of the any significant way of really, really boosting that top line revenue or cutting expenses. And I don't mean above market rents or below market expenses. You have to be realistic, right? If the market is 36% for an expense ratio, give or take, underwrite it to 36. Don't do 33. Don't do 30. Then you're getting into dangerous territory. But if it works with where you've dialed back your metrics conservatively, and you're like, okay, I'm going to clip a 5% coupon on this for year 2 or 3, and when things stabilize, when the Fed stops raising, when there's price discovery, I think you're going to be in a great spot, and we follow that philosophy as well. Yeah. One of the things that I'll mention is that cash flow is great. I'm not knocking it, but a 6% versus an 8%, it's not that big of a difference when you step back and you do what's called partitioning the return. So if you were to look at a deal, whether it's development or value add or stabilized, and you say, what percentage of my returns are coming from cash flow versus are coming from if we do a refinance, am I getting any cash out refinance from that? And how much cash am I getting from the reversion or the sale of the property, right? Typically, most of your money is made on sale. So are you really going to give up? You're not giving up that much. For me, if you're willing to accept a 5 or 6% cash on cash versus an 8, because typically the upside on the back end is going to be bigger, even with a conservative exit cap rate in it. So I would rather not go for the extra couple points, in years, 1 through 5, 6, 7, whatever it might be, and have a better pop either on the refi or on the sale at this point.
Yeah. Yeah, for sure.
Well, what do you say, Mark? We're at the top of the hour.
Oh, wow.
This
That went
hour
really
went by
fast.
fast.
Yeah. That's crazy. You guys have any final thoughts, comments?
No, just I appreciate you both having me on. It's been a pleasure. If I may just mention my my
Absolutely.
site. It's Southgate Real Estate Ventures. The website is S as in Sam, R as in Roger, E as in Edward, Ventures, VENTURES. And there's a button where if there are listeners who are interested in learning more about that market, there's a schedule a call button. I would encourage you to do so. And I just appreciate Mark and Matt having me on this podcast today. Thank you.
Yeah, we'll check you out.
We'll throw your contact info down in the comments too for anybody that's listening that wants to click. And we'll see you guys next Thursday at 2.
All right. Thank you very much. Bye-bye.
Yeah.
All right. Peace.